Welcome to Financial Fortitude, your ultimate destination for financial wisdom. Are you ready to take control of your financial future? Look no further. Our channel is here to guide you through the complex world of finance. Whether you're a seasoned investor or just starting your financial journey, we've got something for everyone. And don't forget to be a part of our growing community. Like, subscribe, and hit that notification bell so you never miss out on our valuable insights. Stay tuned for a wealth of knowledge on financial fortitude. Let's get started. In this video you will be understanding dividends and yields. Investors are always looking for ways to make their money work harder for them, and dividend stocks are a great way to do just that. Dividends are regular payments made by companies to their shareholders, and the yield is the percentage of a company's stock price that is paid out in dividends over the course of a year. While dividends can be a great source of income, they can also be confusing and intimidating to beginners. In this video, we will demystify dividends and yields, and provide you with a beginner's guide that will help you understand the basics of dividend investing. We will explain what dividends are, how they work, and what types of dividends are available. Whether you're a seasoned investor or just starting out, this video will provide you with the knowledge you need to make informed decisions about dividend stocks. Introduction to dividends and yields. Dividends are a way for companies to share their success with their shareholders and provide them with a steady stream of income. They can be particularly appealing for investors who are looking for a more passive form of income or who prefer to receive cash returns rather than relying solely on capital appreciation. Yields, on the other hand, are a measure of the return on investment, ROI, that dividends provide. It is calculated by dividing the annual dividend payment by the price of the stock. For example, if a stock is priced at $100 and pays an annual dividend of $4, the yield would be 4%. Understanding dividends and yields is crucial for investors as they provide insights into the potential returns of a stock. A high dividend yield may indicate a company that is distributing a significant portion of its earnings, potentially making it an attractive investment for income-focused investors. Conversely, a low or non-existent dividend yield may suggest that a company is reinvesting its profits back into the business for growth. It's important to note that not all companies pay dividends, especially those in the growth phase of their business. Instead, they may choose to reinvest their earnings to fuel expansion and increase the value of their stock over time. This is why it's essential to consider your investment goals and risk tolerance when evaluating dividend-paying stocks. In this video to dividends and yields, we will delve deeper into these concepts, explore different types of dividends, discuss how to evaluate dividend stocks, and provide practical tips on incorporating them into your investment strategy. By the end of this video, you'll have a solid foundation to navigate the world of dividends and yields, empowering you to make informed investment decisions. What are dividends and why are they important? These payments are typically made on a regular basis, such as quarterly or annually, and are often seen as a way for companies to share their financial success with those who have invested in them. Dividends can be in the form of cash payments, additional shares of stock, or even other assets. So why are dividends important? Well, they serve as a tangible reward for shareholders, providing them with a direct return on their investment. For income-focused investors, dividends can be a reliable source of passive income, especially from well-established companies with a history of consistent dividend payments. Furthermore, dividends can also be an indicator of a company's financial health and stability. A company that consistently pays dividends demonstrates its ability to generate profits and distribute them to shareholders, which can be seen as a positive sign for potential investors. However, it's worth noting that not all companies pay dividends. Some may choose to reinvest their profits back into the business for growth and expansion instead. This is more common among younger, high-growth companies in industries such as technology. Dividends can also play a role in determining a stock's yield, which is a measure of the return on investment in relation to the stock's price. By dividing the annual dividend by the stock's current price, investors can calculate the dividend yield and compare it to other investment opportunities. In summary, dividends are an important aspect of investing that can provide both financial rewards and insights into a company's stability. Understanding how dividends work and their significance can help beginners navigate the world of investing with greater confidence and make informed decisions about where to allocate their funds. Different types of dividends. Cash dividends. This is the most common type of dividend, where companies distribute a portion of their profits in the form of cash payments to shareholders. Cash dividends are typically paid on a regular basis, such as quarterly or annually. Investors often appreciate cash dividends as they provide a steady stream of income that can be used for personal expenses or reinvested into the market. Stock dividends. In contrast to cash dividends, stock dividends are paid out in the form of additional shares rather than cash. For example, if an investor owns 100 shares of a company and receives a 5% stock dividend, they will be granted an additional 5 shares. Stock dividends don't directly impact an investor's cash flow, but they increase the number of shares held, which can potentially lead to future gains. Property dividends. Property dividends involve distributing assets other than cash or stock to shareholders. This could include physical assets like equipment or real estate, or even shares of another company that the distributing company holds. Property dividends are less common than cash or stock dividends and are usually given when a company wants to divest certain assets. Special dividends. Special dividends are one-time payments made by companies in addition to their regular dividend distributions. These are often declared when a company experiences exceptional financial performance, receives a windfall gain, or wants to reward shareholders for specific reasons. Special dividends can be in the form of cash, stock, or property. Understanding the different types of dividends allows investors to evaluate the financial health and strategies of the companies they invest in. It's important to note that not all companies pay dividends, as some may choose to reinvest their profits back into the business for growth or other purposes. Ultimately, dividends can be an attractive feature for many investors, providing both income and potential capital appreciation. How are dividends paid? When a company generates profits, it has several options for utilizing those funds. One of those options is to distribute a portion of the profits to shareholders in the form of dividends. These dividends can be paid out quarterly, semi-annually, or annually, depending on the company's dividend policy. There are different methods through which dividends can be paid. The most common method is cash dividends, where shareholders receive their dividend payments in the form of cash. These payments are typically deposited directly into the shareholder's brokerage account or sent via check. Another method is stock dividends, also known as bonus shares or scrip dividends. Instead of cash, shareholders receive additional shares of the company's stock. For example, if a shareholder holds 100 shares and the company declares a 10% stock dividend, they will receive an additional 10 shares. Some companies may also offer dividend reinvestment plans, DRIPs. With DRIPs, shareholders have the option to reinvest their dividend payments back into the company by purchasing additional shares, often at a discounted price. It's important to note that not all companies pay dividends. Some may choose to reinvest their profits back into the business for expansion or other purposes. These companies are often in growth industries where reinvesting profits yields higher returns for shareholders in the long run. Understanding how dividends are paid is essential for investors, as it helps them evaluate the potential income generated by their investments. By considering the frequency and method of dividend payments, investors can make informed decisions about their investment portfolios and strive for financial success. Strategies for investing in dividend-paying stocks. Dividend aristocrats. Consider investing in companies that have a long history of consistently increasing their dividends year after year. These companies, known as dividend aristocrats, have demonstrated their ability to generate stable and growing cash flows over time. Researching and investing in these established companies can provide a reliable income stream. Dividend yield. Another strategy is to focus on stocks with high dividend yields. Dividend yield is calculated by dividing the annual dividend payment by the stock price. However, it's important to note that a high dividend yield may not always be sustainable or indicative of a healthy company. Conduct thorough research into the company's financials, dividend payout ratio, and overall stability before making any investment decisions. Dividend reinvestment plans. DRIPs. DRIPs allow you to reinvest your dividend payouts back into the company's stock, often at a discounted price. This strategy allows you to take advantage of compounding returns over the long term by accumulating more shares without incurring additional transaction costs. Diversification. As with any investment strategy, diversification is key. Building a well-rounded portfolio of dividend-paying stocks across different sectors and industries can help mitigate risk and potential losses. By spreading your investments, you can benefit from multiple income streams and protect yourself against the volatility of individual stocks. Research and due diligence. Before investing in any dividend-paying stock, it is crucial to conduct thorough research and due diligence. Look beyond the company's dividend history and consider factors such as financial health, industry trends, competitive advantage, and management team. Understanding the company's fundamentals will help you make informed decisions and avoid potential pitfalls. Remember, investing in dividend-paying stocks requires a long-term perspective and patience. It's important to have a clear investment strategy and stay updated on market trends and economic conditions. By following these strategies and continuously educating yourself, you can navigate the world of dividends and yields more confidently as a beginner investor. We hope you found our video to dividends and yields helpful in demystifying these important concepts in the world of investing. Understanding dividends and yields is crucial for any investor looking to make informed decisions. By breaking down the key components and providing practical examples, we aim to equip beginners with the knowledge and confidence to navigate the world of dividends and yields. Remember, investing is a journey, and with this newfound understanding, you are well on your way to becoming a savvy investor. Happy investing! Thank you for joining us today on Financial Fortitude. We hope you found this information valuable and insightful. Stay connected with us by following our social media channels, and remember to share our content with your friends and family who might benefit from it. Don't miss our next video, where we'll dive even deeper into the world of finance and provide you with tips to secure your financial future. Before you go, don't forget to give us a thumbs up, subscribe to our channel, and leave your thoughts in the comments section below. We love hearing from you. Once again, thank you for being a part of our financial community. Stay financially savvy and take care.